Today, we are diving into a really fascinating new working paper from the Bank of Japan. It takes a hard look at a huge and maybe underappreciated source of potential risk in Japan's financial markets, foreign investment funds. So let's get into what they found.
Okay, so the paper we're unpacking is called The Presence of Foreign Open-End Funds in Japan's Financial Markets. And it's a really deep dive into how these huge global players can basically act as a pipeline, transmitting stress from other parts of the world directly into Tokyo's markets.
And this research comes to us from a team of 4 at the Bank of Japan's Financial System and Bank Examination Department: Kenta Yamamoto, Tomohiro Okubo, Nobuhiro Abe, and Yukio Minoura. The abstract really lays out their game plan perfectly. First, they track the flow of money in and out of these funds, especially when things get hairy. But then, and this is the key part, they try to estimate just how sensitive asset prices are to all that selling. The big idea here is that when a global crisis hits, the money pulled out by these funds could really shake up Japanese markets. So, here's how we're going to break down their research. We'll start by looking at just how big the footprint of these foreign funds really is. Then we'll get into the nitty-gritty of the data and methods they used. From there, we'll see exactly how these funds behave during a crisis, measure the market's price sensitivity, and finally bring it all home with the big takeaway. All right, first up, just how significant are these foreign funds in Japan? Well, as the research shows, their footprint is pretty massive. Yeah, their holdings have just exploded since the global financial crisis. And if you look at who's behind it, U.S. domiciled funds are the main event, making up more than half of the total. So what are they buying? It's mostly equities, about 70% of their holdings. This concentration means they have a huge presence. To put it in perspective, these funds now hold over 10% of the entire Japanese stock and REIT markets. That's a huge slice of the pie. Okay, so how did they figure all this out? Let's get into the mechanics of the study. The researchers set up this really smart 2-stage investigation to draw a direct line from fund behavior to market impact. They basically broke their investigation into 2 main parts. First, they just looked at the money itself, tracking the inflows and outflows, seeing what these funds were selling, especially when markets were in panic mode. Then, for stage 2, they tried to nail down the price impact. They asked the million-dollar question: how much do these sales actually move the needle on prices? Now, to do this, you need some seriously good data. The cornerstone of their work is the LSEG Lipper database, which gives them incredibly detailed fund-level information. They then combine that with trade flow data from the Bank of Japan and the Tokyo Stock Exchange. It's really this combination of sources that gives their analysis so much power. So, they've got the method, they've got the data. What happens when they point it at a real-world crisis? The results are, well, they're pretty eye-opening. Just look at this chart. This is the COVID-19 shock in March of 2020. I mean, money was just pouring out across the board. But you can see that bond funds got hit especially hard. The outflows there were substantially bigger than in equities or real estate. It was a classic broad-based dash for cash, and everyone was rushing for the exits at once. But here's a really interesting point they make. Not all shocks are created equal. They contrast what happened in 2020 with the market turmoil in August of 2024. See, in 2020, the panic was widespread, driven by this huge demand for liquidity. But the 2024 event was different. It was mostly driven by hedge funds repositioning in the futures markets. And the result? A totally different story. No major outflows. In fact, bond funds actually saw money come in. So the crucial takeaway here is that the type of shock is everything. So digging a little deeper into those massive COVID outflows, their analysis revealed a really clear pattern. It all came down to liquidity. Funds holding less liquid assets were way more vulnerable. For bond funds, if you held more non-investment grade debt, you saw bigger outflows. Same for equity funds. If you were focused on less liquid small and mid-cap stocks, you got hit harder. It's a textbook liquidity mismatch playing out on a global scale. This brings us to the second, and you could argue the most important part of the whole analysis. They set out to quantify the actual market impact by estimating something they call the macro multiplier for Japan. So what on earth is a macro multiplier? Well, don't worry, it's not as complex as it sounds. In simple terms, it's just a measure of how much an asset's price moves when there's a shift in supply or demand. You can think of it as measuring how steep the market's demand curve is. A big multiplier means the market is inelastic, which is just a fancy way of saying a little bit of selling can cause a huge drop in prices. To estimate this, they had to use a really clever and sophisticated technique called the granular instrumental variable, or GIV method. It's designed to solve that classic chicken and egg problem in finance. Does selling cause prices to fall, or do falling prices cause selling? The GIV method helps untangle that by using very specific isolated demand shifts, like an insurance sector rebalancing its portfolio, that have nothing to do with the broader market. This lets them get a clean read on the true causal impact of fund flows on prices.
So after all that complex modeling, what's the magic number they came up with? For Japan's stock market, the estimated macro multiplier is right around 5.2. Okay, 5.2, so what? What does that actually mean? Well, to put it in context, that number is right in the same ballpark as estimates for the US stock market, which usually fall between 4 and 6. The bottom line here is that Japan's equity market is highly inelastic. A sudden wave of selling, exactly the kind you see when foreign funds are rushing for the exits, can have a massive, outsized impact on prices.
All right, let's put all these pieces together. What is the big takeaway from this research? What does all this mean for financial stability? The paper's conclusions are crystal clear. You get a global shock that has nothing to do with Japan, say US rate hikes. That triggers outflows from these foreign funds. To get cash to their investors, the funds sell what's easiest to sell, which often means Japanese stocks and bonds. And because Japan's markets are so sensitive, those forced sales can cause some serious price swings, essentially importing volatility from abroad. And here's what's really crucial. The underlying problem hasn't gone away. If you look at how much cash these funds are holding or their exposure to risky debt, those levels are right back to where they were before the COVID shock. This strongly suggests that the structural risks that made the 2020 shock so bad are still very much with us today. And the authors really don't mince words in their conclusion. The risk isn't just about stock prices going up and down, it's a potential threat to Japan's entire financial system. As they put it, these shocks to foreign funds pose a continuing risk to Japan's financial institutions themselves.
This research really shines a light on just how tangled up our modern financial system is. It shows how decisions made by fund managers thousands of miles away can directly amplify risk in Tokyo. And it leaves us with a critical question, one for policymakers and investors alike. Given that this vulnerability is still out there, just how resilient is Japan's financial system to the next global shock?